Hey everyone, welcome to the deal analysis webinar number 21, featuring a 62 unit somewhere in the States that Drew's going to talk about. Really excited because Drew's one of our coaches, and he did this deal a little while ago, syndicated it. So I'm excited to talk more about that. If you're just joining us now, just let us know where you're calling in from. I know there's a whole bunch of you already live. You guys are here on time, which I love it. I've trained you so well. Fantastic. Look at that. So say hello in the chat box. Let us know where you're calling in from. Awesome, man. Well, I'm excited that you finally get to present this deal, Drew, because it's a great one. It breaks a few of our underwriting guidelines, and I love it. Hey, right. Jason, how's it going on? Got Meetool from Philly, Bram, Fairlawn, New Jersey, Sanjay from Atlanta, Dave, Ann Arbor. There you go. Charlie from Charleston, Jim from Philly also. Awesome. Josh from Nashville, welcome. We're going to get started here in just a second once I get done. Welcome, everybody. Matt from Cincinnati, how's it going? I know a good number of you guys are on live, which is great, even though you can look at it from the replay, but you can't ask us questions. So this is why you guys are here live. So awesome. Well, all right, man, I appreciate it. Thanks very much for being on time, you guys. And what I want to do is I want to welcome you all to Deal Analysis Webinar number 21. Hard to believe we've been doing this for almost 2 years now, every single month. So today I have with me one of our coaches, Drew Kniffen. And what I love about our coaches is several things. One is they share my passion for helping you guys do your first deal, but they're also doing deals themselves, and which is just awesome. And so this is a really great case study. It's a 62 unit value add deal. And Drew, why don't you kick things off? Just give everyone a brief introduction of yourself, and then we'll get into the deal.
Sure. Thanks so much, Michael. Well, good morning, everyone. My name is Drew Kniffen. I'm one of the coaches with the Michael Blanc program, and I'm excited to share my 62-unit deal with you all. Just a little bit of background on myself. I came out of grad school and worked as a W-2 job with a Fortune 500 for a number of years, and during that time started doing some single-family homes and basically fell in love with the magic of real estate. But I was running out of time raising a family, doing the W-2 job and real estate. And the real estate continued to grow and move from a hobby to something where it was taking up more of my time, and bought a few properties and was able to make the leap out of my day job into real estate full-time. That's a longer story, but I'm giving the short story. And met Michael recently, and we started working together. And I've had the privilege of helping a number of people as their coach, and wanted to present today a deal that we just finished closing on last year, and wanted to tell you the story of what's happened both coming up to the closing and then the 12 months afterward and how it's actually gone.
Gotcha. Awesome. So some housekeeping. If for some reason you don't hear anything or see something, hit refresh on the page. And if that does not work, then catch the replay, please. So can everybody hear us online? It looks like one person can. Just type in yes if you can hear us. So we're also going to do a Q&A at the end. All right. So you can put your questions in. I'll mark them as a question, and then when we get to Q&A, Drew can then answer those questions. So Drew, why don't you? Awesome. All right. Awesome, guys. So why don't you go ahead and present the deal, and then we'll get into the SDA.
Sure. Okay. So I'm going to share my screen now with you guys. On this, just to give you the full story. So this deal takes place in St. Paul, Minnesota, which is where I lived for 10 years. So it's an area that I'm familiar with, and that becomes part of the story here. So background on who was in the deal and finding the deal. The investor group is myself and other multifamily investors in the Twin Cities that I have known and been doing deals with. We've been networking and meeting together for a number of years. And it's an example of the importance of building relationships, because good people want to work with good people, and that was the case in this deal. So this deal, a friend of mine named Alex had been reaching out to brokers and building relationships, and this deal came to us because the broker reached out to him and said, "Hey, I got a great listing. I haven't publicly marketed it yet. I want to see if you guys are interested." And so we got a chance, because of our network and our relationships, to bid on this deal and wrap it up, put it under contract before it went out to the wide open market, the LoopNets, and all of the emails of the world. So I thought I'd just give you a couple of nice pictures of this place. It's a 62-unit property in just north of St. Paul, Minnesota. And we have other properties in the same zip code, so we know it. It's a nice C-class area, and the numbers just look really good on it. So that's the exterior. Here are some interior shots of it. Many of these photographs are after we repositioned about half the units, so they didn't look so nice at first, but this is what they look like after the fact. And just a little background, so you can see on the top right here is the subject property that we were looking at purchasing, the one that we're discussing here, the 62 units. We had another one that was 32 units, just maybe 6-8 blocks away. So we knew the area, we knew what the numbers were. There really wasn't any guesswork for us involved in what the rents would be once we were able to reposition the property. And the fact that we had data and knowledge about the area enabled us to come in with a strong offer, a solid offer, and be confident that we were still going to make some good money on this deal. So before the deal, I want to talk about what the work was that we did leading up to the deal. So what you have to do to find these kind of off-market pocket listing deals. So in January, the very beginning of the year, we began developing relationships with brokers in the area. We're having phone calls, we're having coffee, having conversations, providing feedback on deals, trying to build rapport, trying to build our name with those brokers who are sort of the key to deals. So the key here is that for a good 6 months, we were pushing on those relationships, continuing to have those networking opportunities, and nothing appeared to be happening. We weren't getting good traction. So it was easy to get discouraged during that time, and it was discouraging because it seemed like there was no fruit from our labor. In August of 2016, we were brought this off-market opportunity. So after some negotiations and getting the deal under LOI, we were able to develop an investment memorandum and present it to our investors. And in December of the year, we closed on the deal. So from January to December, a full 12 months is really the arc of initiating relationships to closing on the deal. So our offer itself was basically $3.5 million for the 62 units, which is $58,000 a door. In addition, we raised $205,000 for repositioning the 31 units, as well as common spaces, exteriors. And there was no expected cash flow on the property during the stabilization period because the cash was being thrown back into the property to get it stabilized. We were able to get an awesome financing package for this deal. And again, that goes back to relationships. So we got 80% loan to purchase. That was because we'd done deals with this bank before. They knew that we performed and that they knew that we were straight shooters. They did hold back funds for the renovation. So execution on the deal. These are some numbers. So from closing in December of last year till now, these are basically the numbers. So revenue per month, pretty good trajectory up and to the right as we filled units. Vacancies per month started at 30. I think we started at 31, but upon acquiring the property, as often happens, your vacancies tick up a little bit because the tenant base realizes that you're for real and you're not going to accept late payments. And some people decide to move to different locations. So vacancies ticked up a little bit, and then they've come down, and we now have every single unit occupied as we speak. And as a result of those two things, we've gone from negative NOI every single month to positive in September. So we just kind of, you can call September the first month in which it was stabilized. The magic ingredients for a deal, so things that helped us make this happen. Networking consistently and intentionally with brokers, investors, and bankers. Having a track record, obviously, by definition, you don't have that on your first deal, but it's the momentum that you build up by working hard. So we got very strong financing due to a bank that knew and believed in our ability to operate the building well. And we already knew the area, so we were confident in our numbers. And this goes to the concept of having a sandbox, having a zip code or an area of town that you know well, and you can be a smart, aggressive investor because you know that area and you've reduced risk because of your knowledge. And this, thirdly, confidence in your numbers. Based on the NOI, the trailing NOI on the deal, we overpaid for it. But sometimes that's necessary to get the deal in the competitive market to buy the distressed asset. And Michael has a really good webinar or video on this, dated June 6th of this year, called How Overpaying for an Apartment Can Get You a Deal. And this is a great example of that. So going forward on this deal, we plan to refinance it in about a year once it's fully stabilized and seasoned. We want to pursue agency debt, which is Freddie Mac debt or Fannie Mae debt. These debts have longer amortizations, lower interest rates, and non-recourse status. So in almost every way, this debt is better, but their underwriting qualifications are pretty stringent. And so you have to have a very stabilized, nicely performing asset before you can get this type of debt. We plan to return about 60 to 80% of the investor's capital at the refinancing event. And our current value, we estimate at about $4.3 million. So we've created about $750,000 of value, we believe, on this deal. And we've come close to doubling investors' equity in 1 year. And after the refinance, and they have a new basically basis in the investment, our cash on cash returns to the investors should be around 15% on an ongoing basis. So after that, hold the high quality asset for the long term and find the next deal. That's our plan.
That's good. Nice looking deal. Thank
you.
Yeah. All right, let's crack open the underwriting.
So this is an SDA that I made, and it is a bit simpler than most of our SDAs because the deal was an off-market pocket listing, and it was basically a non-performing asset since half of it was empty. They really didn't give us a trailing 12 months. They gave some very crude numbers. So these are some back of the envelope numbers that I was putting back into the SDA. So I'll run you through what it looks like. They were asking 3.6, and we originally offered 3.5, 3.4, and it came down a little bit once we realized the extent of the vacancy. I have the vacancy here at 52% to reflect the property when we purchased it. And so really, if you look at the NOI, it was not making any money to begin with. So you could put any cap rate you wanted on it, and it was worth effectively $0 if you were valuing it based on the NOI. So that's where conventional analysis really breaks down. Going to the summary, let's see here.
Make that a little bigger, Drew.
Yep, let me zoom in here.
130%, yep.
Zoom.
Or you can just use the slider in the lower right-hand corner as a plus and minus sign.
There we go. Yep.
There you go. Yep.
Okay. So we have 20% down, which again was amazing to get on a deal that was half empty. Closing costs were $98,000.
Drew, let me ask you something on that. What kind of debt was that?
It was, the rate is 25-year amortization, and it was 4.4%. So it wasn't particularly expensive bridge debt. It was structured more like conventional bank financing.
Was it recourse or non-recourse?
It was recourse.
Okay, so was it a local bank, or who was the lender?
Yeah, local bank in the Twin Cities that we've done a number of deals with. We knew the lender well. You know, we've gone out for drinks and coffee with the actual guy representing the bank. So there's a deep relationship there, and I doubt we could have put this deal together without that relationship, because getting 80% down on or 80% loan on a non-performing asset is, you know, the more I'm around real estate, the more I understand how phenomenal of an opportunity that was.
Yeah, that's right. And that's kind of a lesson for everyone here. When you're dealing with distressed assets, you need a bridge loan, and unless it's a larger property in an area that will get national lending, you have to go to the local banks, and it will most likely be recourse, which is the downside. But again, it's only going to be even less than 2 years long. So, nice job getting that loan. All right, let's keep going.
So with the scenario 4 is basically my underwriting. We kept expenses at 54%, so kept them fairly high just to be conservative. But even with that, our cash on cash is quite strong, about 15%, as I mentioned. So moving to the P&L, you can see that the average monthly rent at initiation was $638.
Yep. Go ahead and make that a little bigger. 130.
Yep. Here we go.
Yeah.
So you can see that our average monthly rents going in were $638. So they were low, and this was a value add property, both because of the distress and the occupancy of the vacancy, as well as improving and making these units nicer. So we had a real nice bump in rents that first year. To get them to reflect reality, I had to move the annual rent escalator up basically 14%. So it moves from $640 right here all the way to $730, about $90 a unit.
And what was the rent they were getting right then when you bought it? Was it $640?
Yeah, $640.
Okay. So you're for the first year, you're not projecting any kind of rent growth. The only thing you're projecting is an increase in vacancy. Are you projecting? I can't see it there. You're not projecting any vacancy at all?
I think these numbers were they were post vacancy numbers that I was looking at based on the information that I had in my files. So this is a little bit untrue to the way we usually underwrite deals, but because my original numbers were post vacancy numbers, I'm keeping that going forward.
All right. So just to clarify, then you're using the net income numbers, and you can't tell what the gross potential is, and you can't tell the vacancy because that's the all-in number.
That's right. This 540 really should be down here, and the number up above should be more like 560, and there should be some vacancy in here. I just don't have it because the existing numbers that we got when we purchased the property were post vacancy effective gross income numbers.
All right. So you bought this thing with 50% vacancy. What were you projecting as vacancy in the first year then? Since you can't tell from this.
Yeah, the vacancy Minneapolis St. Paul has the lowest vacancy in the nation on some national data. So we're underwriting vacancy at 5% on the property. So that first year vacancy was somewhere like on a sliding scale, starting at 50% and moving down to 5%. So about 30% would be the right number
for the first year. Yeah. Okay. All right. That sounds good. So you're kind of giving yourself 2 years to stabilize it.
That's right. And going back to that slide, we've been able to stabilize it in 1 year. We finished all the turns and we filled up all the units. Right. But for the numbers to fully perform and for the numbers to be seasoned and to have a 12-month look back that banks like to have before they'll finance, we're still going to hold on to this financing package for another year until we're able to refinance.
Was there an interest-only component on that bridge loan there?
This one is not. It is not interest-only.
Wow. Okay.
No, I'm sorry. I'm sorry. I'm thinking about another loan. It is interest-only. You'll see that I've highlighted this in yellow here with the principal. So it is interest-only for this first year.
Okay.
Which obviously gave us more breathing room for the rehabilitation of the property.
Right.
One thing to note, though, is just for all the listeners, when you do an interest-only loan, you do pay for that with a higher interest rate. So if you do 1, 2, or 3 year interest only, your rate will go up accordingly. So there is a cost to that, but it's well worth it to give you that free cash flow and that breathing room to stabilize a property if there's a level of distress on it. So the upshot of all this is that we were able to improve the NOI a significant amount in that first year, from about $207,000 up to about $262,000, based upon moving those rents up.
So were you cash flowing, Drew, in that first year? Scroll down a little bit. Were you projecting a positive cash flow at the end? You were. Okay.
It says this, but the cash flows, as a matter of fact, we didn't distribute cash flows to investors. Right. They were, people knew that the first year was a year of repositioning and stabilizing and improving the value of an asset. So there was cash flow available for distribution, but it instead went back into the asset to improve it.
Okay.
But yeah, there's a refinance in year 2, and the distribution to investors, if I go here, is 62%.
Make that a little bigger.
Yep. Sorry about that. Here we go. Let's slide over here. So the estimated distribution to investors is 62% of their invested capital, or $626,000, which we're really excited about doing because you win so much rapport and so much goodwill with investors when they get a meaningful chunk of their money returned back to them. Everything sounds good, but what really matters is does the money move in the right direction? And once it's back in their bank account, you have their trust. And by the way, they have money they might want to reinvest with you on your next deal. So I'm not sure what else you'd like me to share, Michael. It's been a phenomenal deal for us. It's worked out just according to plan, and we're really excited to start cash flowing and distributing funds to investors this year, and then having the refinancing event.
Okay, that's awesome. All right, we're going to take some questions, guys. We already got one from Kenneth. We'll start with that. So start typing in some of your questions that you have for Drew on this. So Kenneth is asking, there's 62 units, but no payroll costs. Is it all third-party property management fee?
Yes, there is no one on. There's no on-site full-time staff person.
So how does that work then? Because it's kind of like between 50 and 100 units is kind of your in-between thing. There's no payroll. How is a property manager managing this property then?
We do have a couple people that are paid, a small amount for cleaning up the hallways, being eyes and ears to the property, keeping the common areas clean. But the community is really good. The community that existed there when we bought it was it wasn't designed this way, but it happened to be 60 plus years old, and so there was a lot of people that were long timers that weren't putting a lot of distress on the asset itself based on living hard on it. And it simply hasn't required having someone physically there to see it full time. Now we do have maintenance people that are on site there often, that are also our eyes and ears on the property, but it simply has required having someone on site full time.
Yeah. Yep, I gotcha. Chris is asking, there's a member equity 100%. Why did you make it like that?
This was simply, it was a simplification when I was putting together the SDA, since it was afterwards. It is a 70-30 split on the deal.
Okay. What was the property management fee that you said?
It's 5% property management fee, and that includes all leasings, accounting software. It's a pretty inclusive number. So, wow. There's maintenance done by the maintenance company that's outside of the 5%, right. But the 5% is really what the management cost is.
So the property manager does not charge a leasing fee of a half a month or full month. That's included in 5%. Nope. Pretty amazing. You got a nice deal there.
Yeah.
Jim's asking, how did you calculate the cap rate of resale, which is 6%?
Just that's our estimation based upon existing assets that are similar to this that are trading in the Twin Cities. So Michael, the way that we generally model deals in the SDA is that your resale cap rate is half a point softer than your entry cap rate, and we do that to be conservative, to make sure we don't get burned. But in a property where you're fundamentally repositioning it, there is a strong argument that in fact you're going to come out at a basically a better cap rate, because you're turning basically a tough property into a desirable property. And so there's a premium paid for that, not only because you improve the NOI, but also because the cap rate is going to get compressed in your favor.
How much, what are the repairs again, per unit, and what kind of repairs did you make inside and out?
They were 60, well, the repairs were $205,000. And if you took those 205 and distributed over 31 units, it was $6,500 a unit. In fact, we were doing more than just individual units. We were doing common spaces and some exterior as well, although not extensive. There wasn't re-roofing. There wasn't redoing a parking lot. But what we were doing was either painting. We had the properties were categorized. The distressed units were given a score of 1 to 7, and 7 were the most distressed units that needed like a full rehab, and 1s were very light, maybe just paint and carpet kind of thing. So the price per unit to rehab them just depended upon how severe the distress was on each unit, and it went from as light as maybe $1,000 per unit to as much as $10,000 a unit, just depending upon how much work we needed to get them to the desirable level that they're at now.
Right. Scroll up a little bit. There's a question about the breakdown of investors. There you go. Yeah. All right. Good. Thank you. Hopefully you, Dino, that answers your question there. Jason's asking, hey, what advice you have on cold calling and build those relationships with brokers, especially if you have no track record?
Well, you don't have a track record, but you do have a meaningful network within the Michael Blank ecosystem. And so you want to lean on that to say, I'm part of a group of investors that has, existing capital. I can provide proof of funds letter, and we're looking at assets that are whatever you're looking at, 20 to 60 units, 100 units. But you want to always be truthful, of course, but lean on the existing resources that you have within this program to speak meaningfully about why you're a compelling buyer. So, talking to brokers is a lot like dating. You are trying to be attractive, and they're obviously looking for buyers too. So it's a mutually beneficial relationship, and you just want to put your best foot forward while being truthful about the opportunity that you present to the broker to help him find the buyers that he needs to get his commission. And as long as you believe that you really are capable of closing on a deal, which you should be able to speak confidently and powerfully to them about the value that you present to them.
All right. So what I'm hearing you say is, number one, use the right language. And you guys who have the course obviously have that language and the scripts and the knowledge to do that. And the other one also is to talk about yourself, not in terms of yourself, but in terms of your team, right?
Yeah.
So that's what you're doing. You're talking about your team. So that's really the two keys to talking to brokers. Let's see. Blaze is asking, you only repaired half the units. What about the other half of the units?
The other half were in good condition, right? So the property was half vacant when we got it. So the units that were occupied, we haven't repositioned them. I think that we'll look at them on a unit by unit basis and decide how much to reposition them when there's a natural occurring vacancy. But they weren't the focus of our efforts in this last year, because there's been such immediate attention paid to repositioning the distressed units and getting tenants in there.
Yeah, so thanks for that. One of the things I want you to talk about a little bit more is because this deal does kind of break the rule of thumb of how you're supposed to underwrite a deal and value a deal, because the NOI was essentially such where the value of the building was negative, right?
Yeah.
So what is your counsel on how to figure out, man, my gosh, based on that, what should your max offer price be?
Yeah. So this is not a stable buy and hold property. It's a reposition property. And so the reposition strategy requires more execution risk. And because it has more risk, it should garner a higher return for you. You should get a better return. So the way you should back into a price is based upon the IRR that you need to get that is based on your risk. So let's say in general you wanted a 15% IRR. On a deal that's risky like this, maybe you want to get a 20% IRR to compensate you for the risk and the extra time and effort it's going to take. So if that's the case, you're going to figure out what is the ultimate sale price for this asset when it's stabilized. So if in your market this is a 6 cap and you know that afterwards it's worth $4.5 million, then you need to figure out the purchase price that you can that will yield you the IRR that you need. So for here at $3.5 million, we were confident we could produce about $750,000 of value in 1 year. And that worked out to a sufficient return for us and for our investors.
Now, one other consideration might also be the cash flow in year one or even in the early months, right? So that's one thing I would try to look at as well, because you might potentially have negative cash flow in a situation like that. And you're like, my gosh, how are you going to overcome that?
Yeah, and we did. If you look at this, can you guys see the screen right here?
Yeah, there you go.
Yeah, if you look at the far right, this is NOI per month. So in April, this is before making our debt payment. It's just NOI. We had negative cash flow of $40,000. And then you had a loan payment on top of that. So you're $50,000 poorer at that month than you were at the beginning of it. That doesn't sound very good, but if you have built that into your model and you have the cash reserves to ride through that to a cash positive position, that's how you create a lot of value in 1 year. But it's much trickier than a simple buy and hold.
That's right. And you also have to have, in the repairs and reserves section, this is why we always say you have to have reserves in there for unforeseens, and there will be unforeseens, and especially if you have negative cash flow in the first few months, to have enough reserves in there to survive that. The worst thing that can happen to you is that you run out of cash. In that case, you have to do a capital call with the investors, which means that you're going to ask each of the investors for a certain amount of money, and it just upsets everybody. So it's much better to raise just a little bit more money, and you can always return the money as principal returned after the first year or so. Mm-hmm. All right, let's see. Hector came in late and is asking if this was an off-market deal. This was an off-market deal, Hector. So that's that. And this comes through relationships that Drew had built over the months with this broker. Carolyn's asking, if leveraging the Michael Blank Group, do you need to provide proof of funds letter before brokers will talk with you? The answer is no. When a broker asks you for proof of funds, it's a sure sign that you just sounded like a newbie, right? So just make sure you educate yourself. If you don't have the Ultimate Guide course, I strongly recommend it, because it's a level of confidence that you portray that impacts how people will react to you. And when someone asks you for proof of funds or your resume, you just sound like a newbie. So make sure that you have the ability to analyze skills, or using the scripts in the course, and that you talk about terms of your team. And if you do that, you're not going to be asked for proof of funds. Now, you may be required to provide proof of funds as course of doing business, and the sophisticated brokers require it, as well as some sophisticated sellers. And if that happens, we can supply you with one, but only after the LOI is signed. So we have a process for that in the Dealmakers Mastermind portion of the website. So hope that helps. Bram is asking, Drew, what kind of pushback did you get from investors? How did you address your concerns, especially around the fact that it's a reposition deal?
Yeah, this is where you need to know your investors well. For some investors, this is a total deal killer because the risk is high and the cash flow is low initially, and it's not what they're looking for. And so in your mind, you kind of have to have your investors in two different buckets. I have my cash on cash return investors, and I have my value creation investors. And so you need to target the people for whom this is the right kind of strategy for them. So as long as you're clearly stating out what the value is and why there's not cash flow, I don't want to say that there's not going to be any issues, because for some people that's just not interesting. But you've set up their expectations correctly, so that they know going into it they're not going to see anything coming back. So in that sense, the pushback that you get is simply some people say, well, that's not what I want. And then you say, okay, well, do you mind if I keep you on the list for some other opportunities? And for other people, they say, that sounds great. I don't need the money coming back to me on a quarterly basis. But if you can do well for me by repositioning a property, then I'll take it. So that's the sense of pushback that we got, is just finding the right people for whom this kind of deal makes sense.
Yep, exactly right. Let's see. Bram has a follow-on question: is where did you get the cash reserves? Was it part of the syndication or the money raised, or from the bank?
No, it's part of the money raised.
Yep, exactly right. So yep. You raised all that stuff up front. MeTool is asking, hey, can you go over the acquisition tab and how you come up with those amounts in the acquisition tab, and make sure that it's a little bigger, 130. Yep.
So these are not, again, these ones are not exactly true to life, so I wouldn't take this too literally. But the total acquisition cost that we had was $98,000. That was correct. The origination was $28,000. It was a 1%. There were transfer taxes involved, but a lot of these other ones, I didn't go back to all of our documentation and find out, for example, the structural inspection and put those down. So this tab, unfortunately, is not very informative. So I wouldn't lean on this too much.
Right. Gotcha. All right, guys. All right. So let's see. Hector is asking, how did you get your investors? Were they referred to you, or did you find them on your own?
Yes and yes. So there are people that we have found on our own in previous deals. And then when those deals perform well, they get referred to you for your next deal. So just like finding the deal is a function of your network and building rapport with brokers, so too finding your investors is the result of rapport with your previous investors and then referring you to the next group of people.
Awesome. Yep. Fantastic. All right, guys, good questions. Drew, thank you very much for presenting this deal. If you guys don't have the Ultimate Guide and you're asking these kind of questions, I encourage you to take a look at the Ultimate Guide because it will address all those questions. And for those who do have the Ultimate Guide and want to work with Drew or one of the coaches, just go to the coaching page, which is michaelblank.com/coaching, and you can schedule a free strategy session with Drew, Brad, or I. Michael's asking, hey, what was the size of the investment per investor?
The minimum? Was it the minimum?
What was the minimum, and how did it break down? Maybe.
I think the minimum was $50,000, if I recall correctly. So, I mean, some people were higher. Some people were as high as, I think, 150 or 200. Our total capital raise was a little bit shy of $1 million. I think it was $950,000. So it wasn't too many investors. There's 9.
That's nice. Nice job. And your investors are going to be very happy with you, especially when you return the capital, and they're going to go, what do you got now? What do you got next? So
what's next?
What are you working on next, Drew?
Yeah, well, we got 2 deals under contract right now. We have 171 units in Minneapolis, St. Paul. Wow. That one is also, it was never marketed publicly. So we're working on that deal. That was originally a $3.8 million capital raise, and some things changed around. That's scheduled to close on January 2nd. And then there's also a 68 unit deal where we're basically buying the repositioned property fully stabilized. There's very little value add to it, but it's a tremendous cash flow property. So that's another deal where you're just looking for investors that just want cash flow.
That's awesome. Awesome. If you want information about the Deal Desk, you can go to themichaelblank.com/deal desk. You can also access it through your Dealmakers Mastermind website. I do want to announce some changes I'll be making to that. One of the main ones is that we will require a signed LOI before it gets submitted to the Deal Desk, and that's just because we're getting a lot of deals that are just not in any kind of negotiated stage, and it's wasting a lot of time. So we're going to do that and provide some guidance around that. We'll help you get to that point through the coaching to get to the Deal Desk as well. So look forward to running that for that in the next few days. All right, guys, listen, I appreciate it. Thank you guys for being here live. Drew, thank you so much for presenting this deal to us, and then we'll catch you guys next month.